Welcome back to the Social Business Hangout featuring Robert Levine, your social business mentor. The Social Business Hangout podcast series is recorded in Brantford, Ontario in front of a live air audience. Welcome back to the Social Business Hangout. This is episode 101. The Social Business Hangout podcast series is recorded in Brantford, Ontario, in this particular case, in my basement. And we've been doing them from Brantford since day one. Most of our guests are from the Brantford region, and we tend to do this live in front of a group. But for this episode, we're going to be doing it live to air on Facebook. So for those of you that are watching live, welcome. And for those of you that will be watching this a day from now, a year from now, and whatnot, a reminder that this is episode 101, which means there are another 100 episodes of this. And of the highlights, I would definitely recommend number 99, which was the Walter Gretzky interview. But today, episode 101 is on financial planning. And my guest today is
David Prang.
And David, you are a wealth advisor for
Brand Financial Group of Asante Wealth Management here in Brantford.
And you've been doing this for as long as I've known.
This is my sixth year now.
Yeah, yes. So you're I don't want to say a veteran because you know that we don't want to age ourselves too much. But this is something that I know you for a very long time as doing. I don't know you not doing this stuff, so this is a good thing for me.
Okay. Yeah.
From a point of view of why you got into this, because part of the Social Business Hangout here is trying to mix the social aspect in the business. And I know in your particular case, you deal with a lot of people.
Yeah. So my initial career out of university was entirely in the service area, providing services to students at Wilfrid Laurier University here in Brantford. And when it came time to start a family in Brantford, looked for another opportunity that continued to help people. And the financial services area was one of those that hit home immediately because it is a service that at the time we required for our family. And really it's something now as a practitioner, it's my belief that almost everybody has the need for a financial advisor or financial advice at some point in their lives, if not on an annual basis.
So if I'm picking up on this, you literally developed into this out of a necessity for yourself. Like you did it for you before you obviously did it for others.
That's correct. I'd say my family is my best client. But certainly
we call them guinea pigs, but
that's true. Yes. And I know, offline there's lots of stories that can be told about that, but for sure. I mean, your family seeks to support you and you want to support them and help them. So I do have a number of family members as clients for sure.
I always say, it's the friends, family, that are typically the ones that you reach out to, whether or not it's a quid pro quo relationship or just it's dad, I got to do it for dad or whatnot. When you got into it, obviously there's various aspects of financial planning, and that's a very broad term. Was there a certain aspect that you focused on initially, or?
What you find with financial services is that there's kind of three main ways of entering the business or the industry. There's the big banks, the big 5 or big 6 banks. There's the insurance side, your London Life, Sun Life, Manulife, larger insurers, and then there's the independents like Asante and some of our other wealth management partners and friends in the area. So I started with the London Life family, and primarily started working on the insurance side, primarily working with life insurance, and then that training process really evolved into a planning process. So not just the sale of an insurance product, but how does that insurance product solve a problem for a family or a client, and then what are the other areas in their lives that could be addressed to better their financial situation both now and in the future. And then that sort of led to exploring the world of financial services and discovering and moving over to Asante Wealth Management about a year and a half ago.
Mm-hmm. So when you think of insurance, obviously that's for lack of a better term, the unplannable to a degree. So you want to have a degree of coverage in case something happens. And then there's more of what is likely, hopefully going to happen in your life, which is, retirement and growing old and needing this and needing that, which is maybe a bit more thought through. Because I know a lot of people that will do financial planning and not even think about the insurance side, and vice versa, people that think they have insurance and think that that's all they need, but clearly, based on what you've seen, you both are there.
That's correct. A comprehensive financial plan involves, as many or as few as 4 key financial areas. I think we identify about 7 main core ones. In some of the work that we do, there can be up to 70 different areas in your financial life, depending on how complicated your life is. When you add in businesses and extended families and those types of things, our list of services can grow quite extensive. But yeah, I mean, insurance typically involves like life insurance with the various different components within life insurance, and then different policies can do different things. And then you have a critical illness insurance, which covers off your big 3 types of debilitating illnesses, disability insurance, which covers your income and your ability to work. And then there's, of course, the auto and home insurance coverage industry. That's kind of more of a home and auto sector. And then you've got long-term care insurance as a possibility as well. So then within there's travel insurance. Like there's all sorts of different insurance products you can get. It's just how does it all fit together? And really the concept of financial planning is utilizing what resources you have to provide both a plan to get to where you want to go to reach your goals, as well as protecting those goals along the way. Because you never know, blink of an eye, something can happen and can derail those goals quickly. And it's a matter of whether you want to cover it out of your own pocket or whether you want the insurance company to cover it.
Well, I think right there, as you kind of hinted, it's one of those things where are you going to dip into your nest egg to cover this unplanned event, or will you put a little bit of insurance towards it? Because at the end of the day, all it takes is one bad, event for a lot of people to derail any plan. And that's where insurance, I guess, helps.
Yeah, like in today's the weather recently, like how many of us have slipped on the ice over the last 6 weeks, and how many of us have potentially missed a day or 2 of work? Well, if that day or 2 of work turned into a month or 3 or 6 or a year's worth of income that you're not able to cover, are you prepared to do that out of your own savings, or is a different way of doing things a possibility to think about? And what I like to encourage most of my clients to do is we identify what those risks are. It might not be appropriate right now to make that investment, but at least it's my responsibility as a planner and as an advisor to make you as a client aware of what is out there and allow you to make that choice. And I would coach you along the way that it might be better to make that choice than to make the trip to Cuba or something like that instead. But it's really guiding the client to wise financial decisions.
Yeah, at the end of the day, there's different people out there.
Yeah.
Everybody has different priorities, and let's be honest, some of the things you think might happen, and some of the things you think will happen don't. And part of, I guess, wealth management as a whole is to see the ebbs and flows, through your life. So let's maybe break down the various elements that we've kind of, we pre-talked about this. What typically you run into, and this is the perfect time of the year for it. So, for those of you that are listening to it, we are in tax season, and we are talking about RSPs and retirement and all that. So tell me a bit about, for lack of a better term, retirement counseling.
Okay, so retirement counseling, retirement planning is basically setting aside enough money so that you can live comfortably when you retire, when you stop working and stop earning income. And that means a couple of different things. When you're looking at retirement planning or retirement income planning, more correctly, you're also, you have to cover off your Canada pension plan that is currently you've paid into for a number of working years. And then that's a certain level specific to you as an individual. You have to cover off your old age security as an income. And then both of those depend on both of those depend on when you choose to take them, what your taxable income is going to look like. You also then have to look at what your company pensions might be. If you've been fortunate enough to work for a company with a pension, when you stop working, when can you start taking that pension? Is it appropriate to start taking it immediately or later on? If you have more than one pension, do you blend them together? Do you take them out? Do you leave them in? Then there's your private registered retirement savings plans, or RRSPs, as well as your tax-free savings accounts. And retirement income planning or retirement planning is really about minimizing the tax you're going to pay in retirement, maximizing the income that you need, and setting out what those goals are going to look like. So retirement income planning really starts as soon as you start working. And if you have a goal in mind that you want to retire, for example, at 55, and you're earning, say, minimum wage, then that 55 goal might be, okay, it might be 40 years of working, but you got to save 20% of your income to get to that, to get to a level of income in retirement that will match your working years. On the other hand, if your income changes and adjusts, if you have expenses, that's why you meet with an advisor annually to adjust what your goals are going to look like, as well as what your contributions are. So it's really important for most Canadians to really think about what their retirement is going to look like and adjust their savings accordingly annually. But unfortunately, most people don't think about retirement till they're in their 40s or 50s, and their friends start talking about it, and then it becomes maybe a little bit too late to achieve those savings levels.
Well, I think there's also, when we take a look at some of the current student situations, let's say, or just overall situations, some people might just find it too daunting to even think. As you say, if I'm making minimum wage, and we know people that have been 30 years in a career that are still making minimum wage, never saw, a raise in their life. Who knows where their mindset is in that scenario? Do they even bother because it's impossible to start with?
Yeah, and those common questions: do I use a tax-free savings account or a TFSA, or do I use a RSP? Do I put it in a stock? Do I buy marijuana stocks? Or cannabis stocks? Do I pay down my house, my mortgage, and then contribute to my retirement savings plan? And for the most part, there's lots of financial literature, both online and printed, and it's all specific. Your best advice is given to you directly across the table with a professional financial advisor.
Well, I'll put it in context. It's kind of like going to WebMD versus going to your doctor.
Yes.
You can educate yourself. You can understand what they are, but at the end of the day, the diagnosis, there's something to be said about having someone that may have seen these scenarios a few more times saying, yeah, you know what, this is indeed this. Or not.
A professional financial advisor will want to do that, and will want to spend probably 3 hours with you prior to the exchange of like a check coming over or signing a document to move their accounts over, because that advisor wants to know what your goals are, wants you to be committed to a process, committed to the system that with the company that they work for, and they want you to be educated, and they want you to ask questions. They want you to understand how much it's going to cost, and they want you to understand what you're going to get for those, what services you're going to get, and then what your priorities are. So for a 30-year-old, it might be paying down debt and not retiring, or not retirement planning. But for a 40-year-old, it's probably, yeah, we got to start putting some towards the RSP, even though your mortgage is still $300,000. We've got to do a little bit of both.
Well, and like I said, whether or not you got property or you don't have property, whether or not your property is, going up versus down. I know some people, spend more on their properties when the property market was good. But a lot of that, I think, is that variable aspect of finances. Like, I started my business in 2008, just at the recession, great time of the year to, start a new business, right? So the reality is the reality. You can't plan for everything. But yeah, going back to the retirement stuff, when I was making six figures, my taxes then versus what my taxes would be when I retired, drastically different. So yeah, it was about, saving money now, putting money aside, but more importantly, saving money now. It made sense to put it away because I was in some cases making more money, coming back.
For sure. And I think what we found lately with many clients is that some people are going into retirement making more money than they did when they were working. I know certainly that was my grandparents' situation, and that's no longer the situation. You wouldn't be able to have a single income and then go into retirement and make more money than you did when you were working full time. But
unless you're Colonel Sanders and you get that 65-year-old success,
that's right.
That's my plan right there.
There's stock and there's dividends and all that. But for the average the average person, no, you're going into retirement with a plan, and you're understanding where your income's coming from. And for most of our clients that are into the retirement income phase, you're looking at what types of guaranteed income can we get, because the psychological difference between working full-time for a company and getting a paycheck versus drawing down your retirement savings and even though you're getting a check or 2 or 3 or 4 from the government every month, your personal savings are going down, and psychologically that's sometimes a tough barrier to get through. And then do you take CBP at 60 or 65 or 70, and how does it balance with your health? So there's some really tough decisions.
That last one right there, how does it balance with your health? You don't know what you're going to be when you're 50, 60, 65, 80, a slip of the hip. That's all it takes, right?
That's right. Yeah.
So you want to plan. and you want to mitigate risks. And this is where the insurance part, came into it. There's some of that mitigation of
That's
the
right.
risk. And there's planning. And then there's also the realities of life. And like I said, in my particular case, I invested in the business. That was my retirement plan. It's the 10-year plus a few more years success story, right? But at the end of the day, it's me assessing through my conversations where my best success path would be, given my scenario, right? But that's me. You would not have a generic conversation with me, nor would I expect you to have a generic conversation with someone else. Back to that 3 hour of getting to know the person, right?
And that can be spent over 3 or 4 different meetings. It's not necessarily all at once.
Yeah. So one of the other things that comes up a lot, and I think it plays into this retirement aspect, and I hear it more and more and more, and whether or not it falls into yours or not, I don't know, but it probably factors in because it is a revenue source. I think that you're going to be seeing a crap ton of reverse mortgages in the next 20 years, like more than I've ever thought.
Reverse mortgages are an interesting animal. There's one company in Canada that currently offers them, and they're, I think they're slightly growing in popularity. They're certainly not as popular as the payday loan situation, which is its own beast. But they're not. They are growing, and they are potentially a tool. One of the tools that is available that is maybe a different product is maybe a better way of describing it. There's an all-in-one product that's, and I won't plug any particular company, but there are 2 larger companies in Canada. One is one of the 2 larger companies in Canada that offer an all-in-one product that's a mortgage tool plus a savings and investment tool. And effectively, those are perhaps a little bit better than the reverse mortgage because it allows you to, say you have your house paid off, which is what you need to have for the reverse mortgage, but you need to draw some income or need to draw some savings from it. These all-in-one tools allow you to draw equity out of your house, still maintain ownership of the house, and have a lot more flexibility in terms of accounts and signing authorities and those types of things. So we would typically choose to try and use an all-in-one tool as opposed to going the reverse mortgage way. But I agree that as house prices increase and people's net worth are entirely tied to their homes, particularly in the big 3 home environments, that does cause a concern. And to take out a reverse mortgage requires, it's expensive and should be done with the advice of a financial advisor.
Mm-hmm. Well, and I think you might also see scenarios where the real estate brokers might get into that business as well. I think at some point in time, it's because, as you say, right now it's still in that cash day pay loan world, which is a world unto itself that causes a lot of problems. But,
and the broker question is interesting because of compliance questions and whether or not they would be allowed to or they are allowed to.
Well, let me rephrase that. Retiring brokers.
Oh, yes. Taking that expertise. And that's what you find a lot in financial services is that because the skill set in one particular area works really well, you do find a lot of professionals transitioning from one area. And sometimes it's law to financial services, sometimes accounting, and going across different areas. And sometimes that brings a lot of good expertise, and you find some good professionals that have multiple designations across the service areas. Yeah.
Well, let's be honest. Anybody that has gone through or been fortunate enough to get into the home ownership and all that, by the end of it is likely going to be, outside of whatever savings plan you have, your biggest contribution to your future life. And this is where we get into the traditional downsizing. So I sell the house because I don't need the 3 floors, but I need something smaller. So there's money coming in from that plays into the planning, right? Like, what are you planning on doing with your house when you're retiring? And does that now go into what? And as you say, there's something to be said about money that you're taking out when you're 65 versus that same money being put into something when you're 40.
Yeah.
So do we cover everything in the retirement world? Is there anything obvious that's kind of missing? Because I want to make sure that we because I think it's the one that people are going to hit quite a bit.
I think the one thing that we may have missed on a little bit that's fallen out of favor, but it's still something I think that people should begin to ask about some more, depending on their situation, is the idea of an annuity. So annuities are an insurance product, so not necessarily available through the bank, but what annuities do is provide a guaranteed income stream. So for the case of a client that doesn't have a pension, a company pension, for an example, an annuity can replace that pension and a portion of that pension moving forward. So you have your Canada pension plan, your old age security, your retirement income savings plan, your tax-free savings account. And if you don't have a company pension, or even if you do, then you need a guaranteed income stream. An annuity might be that tool for you to use.
So you would be basically paying into this annuity over a period of time and drawing on it when...
Yeah, well, actually, with annuity, for the most part, you make one purchase up front.
Really?
You hand over you write the one check, and then the company that you buy the annuity from guarantees they will pay you a certain amount of money every month for a certain period of time, depending on the type of contract.
So it's purely preloaded.
It's purely preloaded,
it's entirely preloaded.
Yeah, so it is something that with the interest rate environment over the last few years, they fell out of favor.
That would make sense. Now, I understand now why you were saying that.
But now with them sort of increasing a little bit, they're becoming a little bit more of a tool as pension plans have not kept up, or they're equitable. But really, the best part about retirement planning is that is the time that you need a financial advisor the most, is when you're planning on what your income is going to be in retirement.
Yeah, well, it's long tail math, a
Yes.
lot of long tail math,
Yes.
and no offense to those of you that have taken a lot of education in financial planning and math and all of that stuff. Most people, for the most part, would be befuddled by compound interest alone. You know what I mean? So to have someone look at it, do the math proper, show you the curve, show you the outcome, do the what if scenarios with you. Because at the end of the day, it's a lot of what ifs and a lot of, I always say, iterate towards success. You're going to be iterating this a few times. For
sure. And you're going to be adjusting and adopting it annually based on your circumstances. And, there's some, you can get as simple or as complex as you want it to. There's a one-page financial plan that we can pull together, and then there's a probably 120-page document that we can produce, and both will tell you the same thing. It's just how complicated you want to be. But you can also test, as you mentioned, testing different variables. You can run a scenario like 1,000, 40,000, 50,000 times and determine that you're going to meet your goals 90% of those times. And if 2008 happens, that might be that 10% that you don't hit. But otherwise,
as much as I will talk about the roughness of the last 10 years financially, having gone from much financials to less financials, I wouldn't trade it for the world. The lessons learned from those last 10 years were not taught. And I always joke about this. When I decided to leave the corporate world, I could have either gone for my MBA, and like I said, I've got a commerce degree, so that would have been the natural progression, or I could have taken those $200,000 and put it into my own education. It just happened to be the world of Twitter came around at the same time, and I was going to conferences all over the world. 2008 was pivotal. And the reason I bring it up is things tend to go on a 10-year cycle, I find. So there's a lot of FUD going around the next 10 years as well. So you need to see where you are in that, that curve. And it goes from, is it bullish? Is it bearish? Is it high risk? Is it low risk? And, your plan, if you adapt, let's be honest, a lot of people couldn't have predicted the craziness of the Bitcoin in the last year and a half, and how much money that would have gone into this plan went into this plan, how many people made actual money in this plan versus the traditional. All of those things come into play. And, when you got companies like Mogo Financials as an example, and they were touting it as well as part of their recovery, and they're all about debt recovery, and it's like you're doing all of this at the same time. All of those things you couldn't plan for a year and a half ago, let alone 10 days before, whatever. Right?
Yeah, and I think that's where the value of financial advice or the value of a professional advisor comes in, because they see that, they basically have that conversation that you just had, that this is not about what's happening right now and what's happening on this particular website or whatever. It's what's 10 years, what's 20 years, what's 30 years. Okay, if you want to do Bitcoin and you want to do cannabis, let's carve a very cynical way of looking at it. So what would you take to the casino today? Okay, let's carve that out.
That is the best way to look at it.
What are you going to take to casino over the next month? Okay, let's carve that out. That's what we'll put into this particular stock. Or this
and if it does
idea.
Spectacular, great. It's the old thing. You never put in what you're not willing to lose.
That's right. But your core your core investment, your core what you need to retire and save and build, that's going to stay invested in a plan that meets your risk tolerance, and that that if it goes down 20%, it's okay. We're not doing anything. It's staying at 20% because it's going to go up 30%. It'll go down 5. It'll go up 10. Go down 7. Go down 20, it'll be up 50, and it's staying there because we're not looking at it, we're not touching it, because it's invested safely in a way that meets your risk tolerance.
I always say that the biggest problem with the long game is it's a long game.
It's very long. It's very long, and that's the value of financial advice, is that they hold your hand in a very simple way. They hold your hand through those ups and downs, but they also have the stats to back it up that, like over the long term, it's not a wave. It's a very slow and steady climb. But if you looked at the stuff on a day-to-day basis, it's going up and down quite rapidly, and you don't want to be doing that.
No, but I do like the fact that, and you're probably one of the first few people that I've actually heard voice it this way, and this is the casino comment, and I don't go to the casino, but to not have the ability to have something on hand to be able to, whether or not it's day trading, whether or not it's taking advantage of current trends, as you say, the cannabis scenario, right? Like some people should have invested into that 10 years ago, right? And look where they'd be. But there are people getting into it now. Whether or not it was the Bitcoin, which still, like I said, I'm a huge believer in the blockchain. For someone that did IT for years, the concept of a distributed ledger that you could destroy an entire continent and still have the data, God, the IT guy in me is like, yay, So the concept of a blockchain, I think, will replace a lot of your Oracle databases in the next 5 years. But in terms of the currency, who knows, right?
Yeah.
But to not be able to have those short-term reactions, because at the end of the day, some of the wealthiest people I know are day traders, because they're there every day, they follow it. But at the end of the day, they also have an amount that they put aside that is part of the long tail versus the short gain or the short reaction. And if they lose, they lose. But at the end of the day, as you say, it's part of a larger plan.
Yeah.
And like I said, retirement is a huge thing, because I think that's the widest thing where you're not 100% sure what the future is going to be. There's two that I want to talk about, and it's kind of like the flips of the same coin. It's if you've been successful in life, if you will, versus you've had a hard knock. So really, it's cash management and debt management. Okay, so I don't want to necessarily say one's good, one's bad, but at the end of the day, I know that if you don't manage your cash, you will find yourself in the other scenario, and if you properly manage your debt, you will recover and be able to be in the other. So they do play off of each other. And I think for the average person that may not be thinking about the future, both of those are something that are a bit more short-term, medium-term conversations, I think, or more, like debt, it's now,
Yeah, for sure. Like when we have a conversation with a client or a prospective client, one of the things that we gather is what is your income versus what are your debts and what are your expenses. And a lot of people have a hard time coming up with the amount of money. It's not so hard to find out how much money comes in every month. It's finding out where it goes. And the cash flow side of things is really that. It flows into which account or which two accounts. Where does it flow out to? What flows out in cash? What flows out in expenses? And can you get a handle on what those expenses are? And then what can you, and typically when we work with most clients, we can find funds available that can be redirected towards saving, and to find, various different savings accounts to put those in, that where the money comes in, but then it's repurposed for a useful experience as opposed to just, a monthly outflow. So it's that analysis, that monthly cash flow analysis that's really important, because that helps us develop the plan overall, because that tells us, okay, over the course of a year, you should have X amount of surplus cash flow based on what you say your expenses are. Let's add in 10%, and hopefully we're still above net zero. And then let's take that and cover off what your goals are. But then with debt management, obviously that's tied into it. And consolidating debt is certainly important. And we talked about the all-in-one products, or the reverse mortgage, which would be more for a retirement solution. But then we can also do like a regular mortgage or mortgage refinance and setting it up, or purchase with a house, and consolidating debt within a new purchase. So there's all sorts of ways that an advisor can guide and support somebody in coming up with a very neutral cash flow situation.
Well, it's funny, that two things that I picked up on there. On the debt side, it's a lot of the solutions typically comes from consolidation. And on the wealth side, typically is from difference. I can't say the word.
Differentiation.
Thank you.
Yeah.
And I don't know. Is that a generalization? Probably it is, but it seems so simple.
It does. I think it's potentially the mindset. Another way of I mentioned the all-in-one products, and they're not for everybody. And I've come back to them now 3 times, and
well, it's something I would have never known existed.
Right.
So it's valuable information.
But then within those, you can have differing accounts for debt, different accounts for investments, and you can vary. The nice thing about them is that if you don't want to receive 5 different statements a month from your RSP, your tax-free savings account, your RESP, and your non-registered plan, and you just want one statement every month that comes in and tells you where you're at, then that's a good way of doing things, and that's where those products are a good fit.
Well, especially as you go older, when your focus is a bit strained.
Yeah,
having something simple.
It's a good way of doing things. And that's where the industry has really evolved to protect the consumer, protect and confuse the consumer at the same time, and that the consumer gets lots of opportunity to say yes or no and monitor where their accounts are. But at the same time, most are overwhelmed by the amount of paperwork and material that are mandated that they receive. So it's a fine line, and it's the job of a good advisor to coach them through that and say, yes, here's what you absolutely need to know. Here's what you should know, and here's what is really nice to know if you really want that detail.
So, in terms of, and just to recap quickly on the cash management stuff, whether or not you're making minimum wage, whether or not you're making a decent living, or whether or not you're doing quite well, common advice along the way. This is not necessarily for retirement. This is just good day to day. You brought up one about making sure certain things get pulled and put aside before you see it.
Yeah,
that would be one.
If the money's coming in, it's out of sight, out of mind. And recent best practices suggest 10% in the land of pensionless jobs. 15% is typically thrown around as maybe a better place to start. But that can be fairly aggressive if you've also got student debt or consumer debt that's at 19%. Is it maybe better to pay off that consumer debt at 19% than invest it in a TFSA that's earning 1.5% to 2%. So that's where the advice of an advisor can help and say, okay, well, until you chew up that debt, then let's put a little bit into savings so you've got a bit of a cushion every month, but let's get that debt chewed down before we really go after a savings target. So, generally, it's a good thing to do to have a little bit going away every month, regardless of your level of income, just so you have a little bit for that birthday present, that license for your car every 2 years, the timing belt for your vehicle every 5 years, whatever the case may be.
The second that car has a problem, your life changes. Trust me, I know. Yeah. It's to your point. Part of it is just dealing with the realities of what's going to hit you or not. Whether or not you plan for it or not. Part of it is making sure that some of the stuff's putting aside so that you're not even thinking about it, as you say. But, I think also at the end of the day, you said it earlier, part of it's the mindset. Are you viewing this as a disposable? Are you viewing this as something that has an incremental value? Are you viewing as a vehicle for something else? But I think in some cases, some people, the biggest difference between, my line of credit versus my credit card, there's significant digit differences, right? Some students, some people don't know the difference between, a debt on this card versus a debt on this. And I know some businesses, if you're doing quite well, they'll buy that debt off you and put it on a much better, rate card, because to them, it's still money.
That's right.
So most people don't even ask that question. They just assume, well, it was put on here, it's stuck on here. If there's one thing life has told me is, everything is of value to the right niche and to the right business. They can always see a way of making it better, right? But the biggest one that I've noticed is that customer journey as well. Understanding what that customer journey is, and like I said, cash management there's a wealth, a distributed wealth of stories out there with different needs. On the debt side, consolidation obviously is something that I heard a lot. There are 2 types there, and there's full out bankruptcy. Then there's the creditor? No,
consumer proposal.
Consumer proposal. That was what it was. For those that are on that side, because I know, and like I said, it's one of those things where your credit rating gets affected dramatically.
Yeah,
and that changes everything.
Yes.
So maybe just from that point of, the good side of cash management is so that you don't get into the debt management. And let's maybe talk about some of those realities that come from that process.
Yeah, well, certainly from a big picture planning perspective, knowing what your credit rating is and checking it on an annual basis and making sure that checking your credit report is something that you're able to do for free, depending on how much detail you want. It can cost a little bit of money, but
and it's mostly what TransUnion, Equifax, I think.
TransUnion, Equifax are the two big ones,
Yeah.
and most experts would suggest you run from both of them, and make sure that, because some is caught on one and some's not caught.
And there are soft checks versus hard checks. Or I forget what
the soft check is sort of, and again, this is not my area of expertise.
But it plays into it.
Yeah, the soft check doesn't affect your credit rating, whereas a hard check is basically a request for more credit.
So if you're going for, let's say, another car and they're actually processing the paperwork, that would be a hard check.
That would be a hard check, yeah.
Okay,
and that
whereas
would impact
the monthly checkup on your thing, that whatever an app, like mine's on an app, that's a soft check.
That's a soft check. Doesn't impact.
But as you say, knowing where you are on the range definitely affects everything, because when you hear the commercials saying 0 on approved credit, until you don't have credit, you really don't understand what that on approved credit really means.
That's right.
Okay, that's the biggest APR. My God, you've heard it all your life. But, that is a different something to everybody.
It's a different beast, and yeah, I mean the flow of easy credit over the past, since 2009, really since the recovery, that's been a really big danger to Canadian society. And we're if you compared us versus the US at 2008, we're 171% debt to equity, and it's on average in Canada, and it's well above where the U.S. was at the same time. Now, various factors are at play, and we're not quite the same danger zone.
Well, I don't think there's as much toxic investment, or a lot of the, as you say, the easy credit was really easy in the States.
Yeah, and there's fraud and criminal charges and all that kind of
I don't think we're at that necessary level, but in terms of the amount of people that, like I said, what was it? You're 3 payments away from your life completely.
That's right, yeah. Taking, yeah.
And that's missing a job.
Yeah.
In reality, right? Whether or not you're Toronto, whether or not you're anywhere. Okay, so there's really 2 outcomes there really quickly. One is the debt proposal, which is basically just reproposing a number.
Yeah, you go to your creditors and say, instead of $1,000, can we do $750?
Yeah, how many dollars, a penny on the dollar, or whatever the math is, right? But that does have an impact, but it's not as bad if you're compared to full bankruptcy.
As a full bankruptcy, that would stay on your record for, I believe it's 7 years, and it does have a dramatic increase in terms of how you have to report that, and moving forward in your life, it can hamstring you in terms of employment opportunities and those types of things. So,
well, there are a lot of jobs that they will check your credit rating.
Yes,
especially if you're doing anything relating to finances. Right?
Absolutely, yeah.
I know the car industry.
Yeah,
will anybody in auto sales, it's a factor. The recovery side. Because I think that the nice thing between a proposal versus bankruptcy is the recovery process under a proposal is a bit different than on a bankruptcy, and most people never think of that the proposal's an option.
Yeah.
So maybe walk me through that just a bit.
Again, this is a little bit outside but from my understanding, with the professionals that I've worked with clients on, it's an opportunity for the client to get back on their feet in a gentle way that's still respectful, and it still allows them to show that they're an honorable person. They made some mistakes, so they're going to take some steps and pay back the debt over a period of time, make regular payments, build up a credit history again. I think they're allowed to get a prepaid credit card. They're allowed to demonstrate that they made a mistake, and it's time to get back into and be serious again, versus the much more restrictive conditions of a full bankruptcy. And it's in both of those, like, there's some assets that are protected in terms of pensions and RSPs and those types of things, depending on how they were structured at the time of the bankruptcy.
And I think this is where it ties back to, because part of that is part of the overall planning. So we've talked about cash planning, if you will, debt recovery planning or whatnot. Assuming all of those work out fine and you've got money to spare, okay, we get into the investment side. So investment planning would be the natural
next step. Okay. Yeah. So investment planning really begins with risk analysis, and that's a conversation. Typically, it's in the context of the industry jargon of know your client and or know your product, but know your client or KYC. And then there's different software tools to use as well. But effectively, it's somewhere between like a minimum of 10 to a maximum of 30 questions that test you as a potential investor, how you stand with theoretical amounts of money to be lost, theoretical amounts of money to be gained, and how does that make you feel over time, as well as your age and your income and your investment experience and your investment knowledge. So it takes all of that, regardless of the company who does the questionnaire, all of that comes together and gives you a rough score, low, medium, high risk, and that allows the advisor to then select the basket of investments to work with the client on, and then that risk analysis then forms the development of a portfolio. And for most cases, you do a risk analysis for each particular account. So you might do a risk analysis for your registered retirement savings account, your RSP, which might be different than your risk analysis for your tax-free savings account, which might be different again from your stock account, which might be different again from your non-registered mutual fund account. So all different specific risk tolerances are appropriate. And then you might have a joint account with your spouse. So they're all different. You might have 6, 7, 8 different risk analysis, but effectively they're all in place to make sure that the investment that you're selecting or the investments that are selected for you or with you meet what your goals are in a way that protects your investment as well.
And as you say, it could be as blended in as many varieties, and it's sliced and diced.
Sliced and diced, and no one is the same. And there's products that are easy that sort of ride and flow within a certain tolerances. Then there's products that are really strictly low income or strictly low risk, strictly high risk, and then you would blend and balance those over time with your advisor.
Well, and like I said, we all know of businesses that were at the top of the chain and are gone now, and we have. Geez, I can't believe we're actually seeing cannabis as an option in terms of a stock portfolio. So who would have thought that, But, you're going to have 70-year-olds, 60-year-olds, 50-year-olds walking up to you and going, I would like to invest in weed.
Yes. No, and I mean, it's one thing is that the industry is going to change, and the what's hot today is not going to be hot 5 years from now, and that's why you develop a robust portfolio that allows you to sort of have a core and then explore with stuff that is interesting. But yeah, you don't want to be in a position where you're constantly chasing stock performance based on the tip of the day on
I think
television channel.
That if I think of it this way. If you're the type of person that's going to be buying a bundle, a package, a portfolio, something that is pre-organized, taken care of, and you're out of mind, you're not involved or whatnot, you do that. If you're the type of person, as you say, wants the sniff of the day or the flavor of the month or whatever, that goes back to that other point. It's like, hey, okay, you're the type of guy that likes to play the stocks. Put aside some money for that. Go. But I don't think it's necessarily part of the long-term plan, going back to that large point.
That's right. Yeah. Like, a good advisor will understand what the needs of the client are. And if one of the needs of the client is to have a little bit of fun, play the market, have a little fun, then let's account for that as part of the plan. But let's not do it with, a portion of your retirement savings if both you and your spouse are relying on that to, buy that second home or whatever.
Earlier you mentioned the casino, right? But we have a casino here.
Yeah.
Someone goes to the casino, has a great thing, comes to you with a bundle of cash that they've never thought was on their, on the horizon. Because the biggest thing I've heard whenever anybody wins money is how quickly they lose it. And I think it's because they don't have someone take that money away from them at the beginning.
For sure. And I think, a quick Google search of lottery winners and their success, it shows you that quick money goes quickly, unfortunately. And, but there are stories where the money has been able to last because it was invested prudently and it was spread out over time. It was invested in a way that it couldn't be spent quickly, and was invested for good too. And I mean, that's I think we might touch on the charitable giving component, but that's where sort of some of those quick winning things can help clients to plan for, how can I best utilize this money to do good for my community down the road.
So you've navigated through life. You've generated, good cash management. You've avoided debt, or at least you've recovered from it, whatnot. You're able to invest. You've now generated a degree of wealth. They say wealth management there. What is that different from everything else we've talked about?
So wealth management is the idea that you want to keep and maintain a certain level of wealth and then distribute it according to your wishes over time, or distribute it basically according to your wishes. And that might be a component that's charitable. It might be a component to family. It might be, a couple of different variables. And that wealth management piece is maintaining that level of wealth in perpetuity, or as long as it needs to be maintained and held for the good of your family or society or your trust, or however it's structured. So wealth management typically would refer to the idea of trusts, the use of life insurance as a gifting tool or enhancing tool, and also in terms of charitable giving as well.
We brought up charitable giving.
We did, yeah.
And apart from the obvious tax benefits, it's a good thing to do. Especially when you're wealthy. There are a lot of very wealthy people in the area that are known for their charity givings. And, the business side of me knows why. Let's talk about the realities of charity.
For sure.
So you've gone through life. Now you got more than you need. So you're going to give some away.
So, I mean, that's an important conversation to have with a professional advisor is, what are your priorities? What do you want to see improved? Do you want to see it done while you're alive? Do you want to see your gift enhanced once you pass away? How do you want to be recognized? So there's a lot of, you mentioned our community. We've got a lot of really good corporate and community citizens that did a lot of good work while they were alive, and a lot that were recognized for that. And then a lot that did a lot of good work after they passed away because of the residual value of their estate, or because of trust or life insurance gifts that they left. So there's all sorts of ways to enhance the value of your gift, and to be, whether you want to be recognized for it or not. Those are all sorts of options. So within many investment companies, I know certainly within Asante, we have a particular arm that's dedicated to providing professional advice for charitable giving that utilizes investment tools and that type of thing to make that happen. There's also in Brantford the Community Foundation, where you can set up and control your own trust. Then there's the idea of life insurance products, where you can set up and control something that's a completely private gift outside of your state, has substantial tax advantages, and again is totally private as well, and protection from creditors at the same time. So there's many different ways of doing it, and that's the value of an advisor, is determining what meets your needs and what meets your goals, and certainly how you want to get there.
Well, and once again, I'm not trying to say that this excludes those that don't have a lot of money, because there's definitely something to be said as part of your financial mix to benefit from a certain tax benefits that come from it. So it's both worthy to note that this is for all forms that give income, but it definitely scales when you have fairly large donations and a lot of people asking for money.
For sure. I know I think of two examples where not particularly wealthy clients. One where the client started early, basically from 30 to 40. The client contributed to a life insurance policy, paid for it, but the charity owns the policy. So now that policy is totally paid up by the client at age 40. The charity owns the policy. That policy is, the client has gotten a tax receipt every year for the policy premium, but then whenever the client dies, the charity will get a nice check, tax-free.
Well, because at that point in time, it's not showing up as inheritance.
That's right.
Or all of that other stuff.
That's right. And the other example I have is the client, not by any means wealthy at all, just a pensioner, retired nurse, basically. But the whole idea is
give her all their lives.
Give her all their lives, yeah. And it's it's a $30,000 policy that taken out after retirement, so relatively expensive for that person, but that's going to be a very nice private gift to the charity that she's chosen down the road.
Well, there's definitely something to be said about how you want to be remembered.
Yeah.
And it plays back to that first point where we were talking about retirement. At the end of the day, this also plays nicely into the concept of succession. What happens after you're gone? Does some of it go to charity, or does it continue? Now, this obviously may apply more to the business side, I'm guessing, but let's talk about the last step there, which is you've gone through it all, you've given some away, you've made some, you've navigated the hurdles of life, but you got a good thing coming.
Yeah.
I just listened to an interview with Paul Stanley of KISS, and he was saying, the images of KISS will outlast me. So that is succession. That is money going to be generated for decades after the death of the original members.
Yeah. So yeah, succession planning would typically apply to business, but then on the sort of the family personal side, you look at estate planning, wills and estate planning, and that is so what do you want your legacy to look like? How long does it? I mean, not necessarily how long does it need to last, because some of that is governed by the law. But succession planning looks at how does the business transfer from one generation to the next, or do the and that's a fairly intense conversation with the business and the business owners.
Well, you would have probably a lot of farmers that would fall into this category.
Farmers are a big portion of that, as well as like the entrepreneurs, the solo entrepreneurs that have built something, from scratch to say, $3, $4, $5, $10 million business.
The 10-year overnight stories that take a few more years.
That's right. But they may or may not have a child in the business, and if that child is not interested in the business, what does that look like? And for the most part, probably they have an advisor, but hopefully if they don't, they're beginning to have that conversation. But yeah, that's something that has to happen, because when you look at cases where businesses don't have a succession plan, if the owner passes away, or if the owner is in capacity, not able to manage the business, those are, for business planning, it's really important that they work with an advisor.
And like I said, just recently we were talking about Bitcoin and whatnot. One of the biggest exchanges in Canada, the guy died supposedly in India, and his wife, who had nothing to do with the business, is now having to pay money to keep the business afloat, and blah, 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 blah. No one cared. No one knew, and this was $1 million plus, company. There are a lot of businesses that will fall apart very quickly, and I've seen quite the range of small, medium to large businesses. And the concept of succession, like my accounts, where are those? It's not even just the business; it's all of that, right?
Yeah, and that's the wills and estate planning piece. Yeah. And with my with almost every single one of my clients, after generally not our first conversation, but generally after our second conversation, where we've talked about what some of the goals and priorities are. One of my questions is, do you have a will, and when was the last time it was updated, and do you have powers of attorney documents prepared? Because those are, my personal belief that those are really essential documents to have, and you have to plan and prepare for what's going to happen when you pass away, because really the only things you can control are your own actions, and at some point you're going to pass away. So you want to be able to control as best as you can what's going to happen to your assets at that point in time.
Well, back in the IT days, we had the joke, what happens when you get hit by a truck, or bus, or whatever the joke is. And like I said, I've seen a lot of examples in the last year where entire documentation of access points to everything from your Wi-Fi to whatnot has disappeared, and it's disrupted beyond belief. And it's it's one thing to plan for these things, and I think this is maybe the long point of this conversation is financial is one part of the planning. There's a lot of stuff that goes on in life, and just to put a fine point on it, I think this is why I love doing these interviews, because each of these topics is a piece of a larger weave of pieces that will get you hopefully through life.
That's right. You
know what I mean? Because as you say, the next part of retirement, as you say, is what's the law side? Who gets the house? Right? And it's a natural. So when you see this business, do you have? Is it like the doctors where they have the special? Is there a referral network in that place as well? Is there a subset of your business? Because those conversations extend to other conversations, right?
For sure. Again, it depends on the complexity of the case. In many cases, particularly with insurance, legal, and accounting, we do a lot.
That's a good three right there. Right?
Do a lot of referrals to lawyers for wills, a lot of referrals to accountants to get books tied up and in place. And then with insurance, the insurance side of things, depending again on the complexity of the situation, sometimes a more complex insurance product is appropriate for the client, particularly in a business relationship. Called a buy-sell, where if something happens to one partner, the other partner's family is able to get out of the business relationship, and the business can continue successfully. So there's all sorts of different things, but that's where each individual case is unique. And I would say that it's a business not necessarily driven by referrals, but with a healthy respect for each profession's what they can bring to the table, and a good advisor will act like a quarterback is generally how it goes, and they'll provide direction and get the advice as needed, and the lawyer and the accountant and the the estate professional, sometimes the executor,
the real estate people, yeah.
They'll all come together and provide that type of service to the client. It's something our office has really specialized in over the last 5 or 6 years.
It's almost as if it's an all-in-one yet again.
Another all-in-one. That's right. Yeah.
Anything we missed?
I don't think so. I think we got to that charitable piece we talked to about investment planning. We actually got to estate and wills, which was really good. Comprehensive financial planning is the holistic term that wraps everything together, and that's the work that the industry in Canada is moving towards. And there's a professional association called Advocates. That's all of the financial advisors in Canada that subscribe to that association. There's a couple of other associations as well. There's the various different companies that have their own advisors. There's the Certified Financial Planning designation, and there's something like 19 or so other different financial planning or financial advising designations that all mean something different, much like almost any set of letters you can find after somebody's name. But really, the CFP is the core designation that most professional financial advisors are looking to achieve nowadays. And even if your advisor doesn't have that, a professional advisor will sit down, answer all your questions. If you don't like their answers, keep pushing them, because they'll get the right ones that you need to know, and they'll be more than happy to work with you.
Well, it goes back to something I think you said earlier. It's that initial 3 hours, and what was it? Know your customer? Was it
know your client? Yeah.
Know your client. Yeah. So KYC.
KYC. Yeah.
KYC. Yeah. Just that alone. If you walk out of this one remembering that one, that applies to everything. If you like whether or not it's web design to customer journey to whatever.
It does. You want your advisor to be, in some cases, it's you might want them to come to your child's birthday party or your child's wedding, and there are great stories about that happening over the years. For the most part, though, you want both the advisor as well as the client want a respectful relationship where you celebrate your successes, you're able to walk together through challenges, and you're certainly able to deliver on promises on both sides that, okay, we're here in a journey together. This is not a 6 or 9 months journey. This is a potentially a 30 or 40 year journey together. So let's try and make it as positive as we can.
Reintroduce yourself, and I'm going to try something different for a change. Tell me why you do this.
David Prang, wealth advisor with Brand Financial Group, part of Asante Wealth Management in Brantford. I do this work to help people. Period.
That is so sweet. That is right on the nose, isn't it?
Yes, absolutely.
Thank you, sir.
My pleasure. Thank you, Robert.
Thank you for listening to the Social Business Hangout. My name is Robert Levine, and you can reach me at socialbusinessmentor.com. The Social Business Hangout podcast series is recorded in Brantford, Ontario, in front of a live air audience. This podcast is available on Apple iTunes, Google Play Music, and Spotify. Stay humble.